This video walks you through problems 4.08, 4.09, 4.10, etc. through 4.16 at the end of Chapter 4 in the CFA Institute textbook, Corporate Finance, A Practical Approach. Now, all of these 9 questions are based on the same fact situation. So, because of the length of all of this, I went ahead and calculated them ahead of time, and I'll just go through them one by one. All right, so the case has Mary Ben, who's a financial analyst, talking with her boss, Bill Cho. Mary's job is to go through and do an evaluation of 4G Incorporated and Qphone Incorporated, which are a couple of Japanese cell phone manufacturing companies. The question revolves around business risk, sales risk, operating risk, and financial risk. And several of the questions just ask you for definitions of those. And apparently her boss, Mr. Cho, doesn't understand this stuff, which I find hard to believe. But suspending disbelief. As Mary goes through, she went through and produced sales analysis in Exhibit A. She went and did some calculations for Qphone in Exhibit B, or C rather. She already calculated degree of operating leverage, degree of financial leverage, and break-even. This is for Qphone. She gathered the information to do the same calculations in Exhibit B for 4G. So some of the work's done, some of it still has to be done. And her estimates in here for both companies, she has sales estimates plus the standard deviation of sales. So she expects $1 million in sales for 4G. The standard deviation of 25,000 refers to how far off the estimate of 1 million could be. If you've had stat class, you'll know that a 95% confidence interval for something normally distributed would be about 2 standard deviations. 2 standard deviations would be 2 times 25,000 or 50,000. So her sales estimate is $1 million plus or minus 50,000. For Qphone, the sales estimate would be $1.5 million plus or minus roughly 2 standard deviations of 20,000. Another way you can measure relative risk here, there's a coefficient of variation, which is the standard deviation divided by the mean of whatever it is you're looking for. And that gives you a relative risk. So if we took standard deviation divided by the mean estimate for both of these, what that's showing us, put them in the same unit, same number of decimal places. Relatively, that's a much riskier estimate because it's 25,000 variance on a variability on 1 million units, and this one has less variability for a larger number. So that's the coefficient of variation. Gives you some idea of relative risk in there. Okay, so we got the exhibits. Let's roll through here and start answering questions. Question 4.08, 4G sales risk relative to Qphones is most likely to be higher, and that has to do with the standard deviation reported in here for 4G is higher, and the relative standard deviation, or the relative variability, is also higher. The most appropriate response to Cho's question regarding the components of business risk. Business risk is the variability in operating income that arises from the variability in your sales as well as the mix of expenses or operating expenses. So sales risk is essentially the variability in the revenue based on price risk, and mostly what we're looking at is volume risk. And then operating risk is the impact on operating income from changes in your sales estimates brought on by the mix of variable and fixed costs. Essentially, the higher your fixed costs, the higher your operating risk. Risk isn't necessarily a bad thing per se, but you need to know how risky things are. Risk makes good times gooder and makes bad times badder. So you need to have some kind of estimate of what those numbers are to be able to plan for best case and worst case scenarios. 410, the most appropriate response regarding Cho's question about the classification of risk arising from the mixture of variable and fixed costs. Well, that's the definition of operating risk. Old Cho ought to go get him a CFA, but I digress. 411. Based on the information in Exhibit B, the degree of operating leverage for 4G at 1 million sales units is closest to. All right, let me erase all of these. To get revenue, I go to Exhibit B. If you sell 1 million units at $108 per unit, that'll give you revenue of $108 million. The variable cost, if you sell 1 million units and the variable cost, call it the cost of goods sold, is $72 per unit, then the contribution is $36 million. Now the contribution is available to pay fixed costs and anything else. So after you subtract the variable costs that vary directly with unit sales, what's left over is left over to pay all the other expenses. Exhibit B gives us fixed costs of $22,500,000 and then subtract that $22,500 from the contribution, and that'll give you operating income or earnings before interest and taxes. So the degree of operating leverage, it's like any of these leverage numbers. Take the number before the fixed expense and divide it by the number after the fixed expense. So it's the contribution divided by the earnings before interest and taxes. Okay, and we get 2.67 like that. We could also just use the formula. The formula for the contribution, if this is price times quantity and this is variable cost per unit times quantity, then the contribution is PQ minus VQ, which would also be equal to quantity times price minus the price per unit minus the variable operating cost per unit. Call the fixed cost F, then EBIT would be PQ minus VQ minus F. Okay, so the degree of operating leverage would simply be the contribution margin, which would be PQ. The contribution is PQ minus VQ, and then divide that by PQ minus VQ minus F. Okay. And that gives you the formula for degree of operating leverage. All right, 412, based on the information in Exhibit B, the degree of financial leverage for 4G at unit sales is closest to, well, we just did calculate the operating income, and then if we take the Exhibit B gives us $9 million up here of fixed financing expenses, all right, basically interest expense, then we have taxable income, $4.5 million. Just like with the other formula, the degree of financial leverage is the amount before the fixed expense divided by the amount after the fixed expense. And here it's 3.00. So that's your degree of financial leverage. Going on to 413, based on the information in Exhibit A and Exhibit C, we're calculating Q-Phone's expected percentage change in operating income. All right, what that's telling us, if we flop back up here to Exhibit A and C, Exhibit A tells us that Mary Ben has forecast the unit sales growth in 2010, this year forecasting 1 million, and expect that to grow by 15%, so 2010 should be 15% higher. That's our forecast for both companies, and we're doing Q-Phone here. So Exhibit A says we expect unit sales growth rate of 15%, and Exhibit C has the degree of operating leverage, which Mary already calculated at 1.40. Okay, so to get the expected percent change in operating income, or EBIT, it's the degree of operating leverage times the percent change in unit sales. So 1.4 times 15%, the 1.4 degree of operating leverage times the 15% projected percent change in sales gives you a 21% change in operating income. All right, and that's just based on the same type of calculation. Again, we did 4G here because it's in the problem. Mary had already done the calculations for Q-Phone before we got to questions 4.8 through 4.16. Stupid questions. All right, 4.14, 4G's break-even quantity of units. To calculate the break-even quantity of units, we take the fixed expenses and divide them by the contribution margin. All right, again, if we were to, the break-even quantity of unit sales is the point where net income would be zero, exactly zero. So PQ minus VQ minus F minus interest is exactly equal to zero. That's what we're trying to find. At what units would that be? Well, if we rearrange terms, if I have Q times P minus V minus F minus int, and that's equal to zero. Now I add the fixed expense and interest expense to both sides of the equation, and it's Q times P minus V would be equal to F plus interest, and then divide both sides of the equation by P minus V, and that way I get Q equals to the fixed expenses plus the interest divided by P minus V. Okay, just pure algebra. If every time you sell a unit you get P dollars per unit, but it costs you V dollars per unit to sell each one, then P minus V is the contribution margin that's left over for each unit to pay all those other fixed costs. So the total amount of the fixed costs that you have to pay, once you calculate that, and here it would be from the Exhibit B, it'd be 22.5 plus 9, that's F plus interest, and then we divide that by the contribution margin, which is 108 minus 72. Okay, and that's where I get 875,000 units. And again, that was already calculated for us for Q-Phone, because that's the numbers that she's reporting in Exhibit C. So the DOL that we calculated for 4G and the DFL that we calculated for 4G and the break-even quantity in units that we calculated for 4G had already been calculated for Q-phone, so that's why we didn't do them. Although it wouldn't have been any trouble to have done them in here as well. Would have been faster than trying to explain that. All right, problem 415. Chose question regarding an increase in unit sales above 2019 sales. It's more likely that 4G's net income will increase at. All right, so we're estimating 15%. The degree of operating leverage, which we calculated for 4G, is 2.67. The degree of financial leverage is 3. Multiply those together. DOL times DFL gives you the degree of total leverage, and the degree of total leverage is the elasticity of net income with respect to changes in unit sales. So if units grew 15%, then the expected net income would grow by 8 DTL times 15%, or 120%. So if we have percent change in units times DTL, that gives you the percent change in net income. Okay? And then for Q-phone, it was given in Exhibit C that was 1.4 for DOL, 1.15 for DFL. So if I multiply those two together, that's much less leverage, so the 15% would produce only a 24% change in net income. So answer is C. What would happen if the increase in unit sales above 2009, 4G's net income would increase by 8 times whatever the percent change is. Q-phones would only increase by 1.61 times whatever the percent change is. So net income at 4G is going to grow faster than at Q-phone. All right, and then this is the stupidest question I've ever seen in my life. Well, not really, but it gives it a run for the money. The most appropriate response to Cho's question regarding a description of the degree of total leverage. Let me take us back up here into the case. The old Cho says he don't know squat. Could you tell me what would be an accurate verbal description of the degree of total leverage? All right. Unfortunately, 416 doesn't give me the choice of none of the above because all of these are stupid. But we know that if you took the percent change in units times the DOL, that would give you the percent change in operating income. If you took the percent change in operating income times the DFL, that would give me the percent change in net income. And so if I multiply this times this, what it's going to tell me is that the percent change in sales, or unit sales, times the degree of total leverage would give me the percent change in net income. All right, and this says the percent change in net income divided by the percent change in units sold. If I just rearrange terms in the DOL, mathematically you could describe it as percent change in op income divided by percent change in units. All right, which is what we're describing here as the DOL. And here, if I do the DFL, that would be the percent change in net income divided by percent change in op income Oops, got these backwards. Alright, so that's the D. No, that's the DOL. And that one is the DFL, following this mathematical shenanigan. So the degree of total leverage, you could rewrite that as the percent of change in net income divided by percent change in units sold, which is answer A up here. That is the DTL. That's a description of the mathematics. That's not what it means. What it means is it's the elasticity, or the effect of the leverage that a change in units sold would have on net income.